Hello, and welcome to this podcast. This is Professor David Lopez. Basic financial intelligence is a critical component to personal and professional success over the long term. Unfortunately, there are numerous examples of individuals who could not master the basics and ended up in very challenging circumstances. This podcast will cover basic information relating to chapters 1 through 7 of the required text. Personal finance basics and career planning are also very important knowledge-based outcomes that will enable an individual to be successful over the long term from a financial perspective as well as a career perspective. We all make decisions in life, and it's important to recognize that all of our decisions have consequences. These consequences can often be referred to as an opportunity cost. An opportunity cost is the emotional, financial price that one pays by determining a course of action. These are also known as trade-offs. Goal setting is a key element in being successful. Once goals are set, the next step is planning. Career planning refers to a process designed to determine an appropriate and rewarding long-term source of income, both tangible and psychic. Financial planning is a process designed to ensure financial success as well as to manage risks on a financial basis. Determining your level of interest in the form of an interest inventory is also very important to determine your personal values and interests that can lead to a long-term and rewarding career. Once you've determined a course of action for your career, there tends to be a very detailed interview process. There can be phone interviews, in-person interviews, screening interviews, which are determined to eliminate, quite frankly, candidates that are not appropriate for a specific position, and this saves time for the hiring team as well as the applicant. The interview process can also involve testing, aptitude tests, math tests, word tests, etc. In order to understand financial basics, there are some key terms and processes that you need to be aware of. Inflation is the gradual increase of the cost of goods and services that occur over 1 year. These can be food, real estate, automobiles. Any tangible product or service can be affected by inflation. The budget process is very important for an individual or a company to be successful. The budget basically is an analysis of monthly income and expenses. It's important to understand where one stands financially on a consistent basis. Assets are considered items of value. They could be cash, securities, real estate, personal items, and they can be liquid, which means you can get at them very quickly, or non-liquid, where it takes some time or in many cases a penalty to get your cash to you. Liabilities, on the other hand, refer to amounts owed to others in the form of a loan, a mortgage, credit card debt, car payments. Liabilities can be current, which means they have to be paid off within a short period of time, or they can be long-term in the case of a mortgage. Understanding credit and expenses are a major piece of the financial planning puzzle. The availability and expansion of personal credit has helped many people get through difficult situations and achieve their financial goals. Unfortunately, it's also caused hardship for many people in the form of foreclosures or bankruptcy. Understanding your expense level and makeup is an important factor in determining your use of overall credit and your ability to get it. Variable expenses can be affected by the time of year, health issues, hobbies, or household needs and changes. While fixed expenses can be associated with rent, car loans, student loans, and insurance. Fixed expenses by their very nature do not change, where variable expenses can be higher or lower based on the referenced situations. Two general rules of thumb for measuring credit capacity are the debt payments to income ratio and the debt to equity ratio. To determine the debt payments to income ratio, one divides the monthly debt by the net monthly income. And the number, generally speaking, and it's just general, would be 20%. If it exceeds that, that's a warning sign. The debt to equity ratio can be determined by taking your total amount of liabilities, all of your loans outstanding, and dividing them by your net worth, which of course is assets minus liabilities. Lenders of credit, whether they're commercial banks, savings and loans, finance companies, will look at what's called the 5 C's to determine creditworthiness for an individual. These are character, your potential willingness to pay back the loan in terms of your potential criminal history, etc. Your capacity based on the 2 ratios we just discussed, so your capacity to pay back a loan, the capital, how much you're actually looking for. Will you be providing what's called collateral, putting something up to lower the risk a little bit for the lender? It could be a home, it could be a car, it could be other assets. And lastly, conditions. What are the economic conditions present to determine whether or not this loan makes sense for the lender? Finance charges are the total cost of a loan to an individual. It could be fees, interest rates, other costs that are built into a loan, whether it's insurance or whatever, that equal the total cost of getting this credit. This is a very important area that many people don't look at closely enough. Sometimes, as mentioned before, people get into financial difficulties with regard to personal credit. The Consumer Credit Counseling Service is a non-profit organization designed to assist individuals who, for whatever reason, find themselves in financial difficulties based on the misuse of credit provided to them. At a very basic level, taxes and investments need to be understood by the average individual looking to be financially successful over the long term. Checking accounts are liquid accounts designed to provide safety, immediate access for funds, but generally speaking have very low rates of return in exchange for that immediate access. Certificates of deposit, or CDs, are longer-term accounts that offer generally higher rates but include a penalty to access the money prior to maturity. These accounts are known as being illiquid. The yield is defined as a rate of return that one receives by placing money in a checking account or a certificate of deposit. When doing taxes, it's important to arrive at a number called your taxable income. Income derived from a job, from dividends, from capital gains, and from interest, and as well as other sources. While tax-exempt income offers income that is exempt usually from both federal and state taxes. Tax-exempt income is usually derived from municipal bonds. Tax deductions are designed to lower the taxable income of an individual. Tax deductions can include dependents, retirement plan contributions, or job search activities. Tax brackets determine the rate of tax liability based on one's level of income. Municipal bonds are debt issued by states in order to build roads and schools and other large public projects. And generally speaking, the interest from a municipal bond, as discussed earlier, is exempt from both federal and state taxes. The Rule of 72 is used to determine how long it takes in years for money to double at a specific rate. And the formula for the Rule of 72 is take the assumed rate and simply divide it by 72. The resulting number is the number of years it will take for that investment to double. Future value is the amount to which current savings will increase based on certain interest rates and a certain time period involved. This is just a single amount that will grow over a period of time. Future value of a series of annual deposits, otherwise known as an annuity, and an annuity is a series of equal deposits, determines a future value of a consistent level of money going in over a certain period of time. Present value of a single amount refers to the current value for future amounts based on certain interest and time periods. In other words, if I want to have a certain amount of money down the road, what do I need to invest now, presently, in terms of one deposit, at what interest rate to hit that number? Present value of a series of annual deposits is used to determine how much you need to deposit now in one lump sum so that you can take a certain amount out of an account for a desired number of years. The solution process using tables is as follows. Determine the appropriate table based on the question, identify the year and the interest rate, and multiply the known number by the factor that you've located in the tables, and that will give you your solution. This has been Professor David Lopez Thank you for listening.